Okay, so we've got the gold market here in front of us. We were talking yesterday a little bit about gold, just for a few moments, but I wanted to bring it up today because if for no other reason, even if you don't trade gold, even if you don't trade futures, and even if you're not particularly interested in dolls, I think this is a good example of what could be an interesting swing setup where we've got the upward angling 12 to 2 o'clock market cycle. Okay, the cycle indication is certainly showing us an uptrend. And then you've got the pullback that we're waiting for to see if something will come of that. Now, let me also go back, and I don't want you to ignore what the current mood of the market is or the current temperament, because I do want you to see that even though this looks good in terms of strictly the angle of the wave, it's relatively smooth, the actual cycle indication has a good healthy clock angle in terms of that uptrend or not markup cycle that we'd like to see. I don't want you to ignore what the market's been doing in the past. I mean, this is pretty erratic and crazy stuff. Now, if you think back, specific to what was happening in the market, specific to the kind of flight to quality gold would see during the trials and tribulations of what was happening in the Dow and the dollar, this isn't that unusual in terms of the weird action that we're getting. Okay, weird. I should qualify. Weird in terms of erratic. Weird in terms of the type of volatility we saw September, October. Okay, so is it capable of just acting really off the wall? Sure. Should we expect it? We should at least be prepared. And then beyond that, um, just simply looking at the charts, is there a good chance we'll see some sort of pullback here? This is GLD. Now, if I pull up to the YG futures contract, okay, you'll see right now we are pulling back. And the price action, while very volatile, isn't quite as erratic. And that's the difference between looking at a stock, or the GLD, which is a gold ETF basically. The gold street tracks is what they call it. And looking at mini gold, the futures contract. Okay, there is typically better liquidity. There's the trading hours are better. The gold contract has better trading hours than the 9:30 to 4 ETF stock market. So you see there's a smoothness here. I mean, there's no doubt you can visually see it. The setup has come. Now why? How could there be a setup in the gold futures and not one in the gold street tracks or ETF? Well, the main reason for that is the gold futures, of course, this is representing the front month contract of gold, and the futures, inherent to their name, are kind of looking forward and saying what they feel gold will be at on a certain delivery month, while the ETF is kind of like cash or now or spot. So there'll be a slight difference in price, there'll be a slight difference in opinion, and obviously trading at 844, okay, versus at the GLD you'll see we're trading at 84.48, pretty similar in price, okay, but this type of erraticness will put the wave in a different spot. So I do want you to realize that there are ways to look at both these charts, but right now, and let's squeeze in some more lazy days lines here. I'm going to backtrack just a little bit and squeeze in those lazy days lines. Now, 1597 candles is what's needed to plot that final lazy day at 1597. That's roughly 6.5 years. That's going to put me back, basically 2001. Okay, and there you go. That's our lazy days lines plotted. You can see the resistance at the top line of the wave. You can see more resistance around 830. I'm sorry, at support. Support at the top line of the wave. Support at this actually is the 233 and the 144 lazy acting as support. And resistance is coming in the form of this 200 period simple moving average swooping down over what actually is the high of today's candle, the 6th. Okay, sitting at 857. So just a quick comparison of the ETF and the futures, and then an overall look at gold. Okay, now when we're looking at gold, of course, the first few things we'll think of are things like the dollar index, or even more specifically to the Forex, what's happening with the Aussie, obviously being a doll. Now, in terms of the relationship, why talk about gold and the Aussie? In terms of the relationship, let's go ahead and make we'll make the Aussie a bright blue. Let's see how that looks. It's pretty easy to see, right? That's really easy to see. So you see the overlay in terms of what we're looking at. The overlay obviously is gold and the bright blue, the aqua, if you will. And of course you've got the Aussie in the black and white. Now, even though in scope there's not a lot of similarity, you can see that gold has been a little bit more erratic than the Aussie. They're both daily charts. You can see that they're more or less moving somewhat together. It's just that gold is a little bit more dramatic than the Aussie. Okay. Another market that will often move with dolls like the Aussie and the Kiwi is the continuous commodity index. I think we've talked about that a couple times, but let me just show you here real quick. I'll pull up the CI here. That's the continuous commodity index, and I'll just do it on a continuous basis. And there you have here. Take a look at that. That's the CI. Looks good, doesn't it? Moves with it very nicely. Okay, so in terms of sympathetic markets and related markets, when it comes to dolls, gold is usually what comes to mind. Gold is what frequently is referred to when looking at the doll of the Aussie. But don't forget, we're still talking about a pair called the Aussie US dollar. We've just gone through the market pulse of gold. How about the market pulse, right, of the US dollar? So now I'm going to overlay the dollar in that bright blue. Let's try that one more time here. We'll do that in that bright blue, and then boom, there we go. And you can see what typically is a really good inverse correlation. Now, here's where it's getting a little odd. Right now, look at the dollar. Okay, we're at 83.98. That's a pretty significant move from where we were during the sideways consolidation between basically the last decent trading day before the holiday, which was the 19th, that Friday before the Christmas week, and then coming back yesterday. You can see that yesterday's price action brought a lot of bullishness, and today here we are way up here. So a lot of movement higher in terms of what's happening with the Aussie and what's happening with the dollar. Now notice these should be inverse, but the last couple sessions, granted this is a somewhat down day for the Aussie, but it did move up higher, and the dollar moved up higher. That's kind of out of character. And what I'm talking about here is what we see here with the dollar. Let me make this a little bit more bold here. What you see here with the dollar, that move up higher, and then you can see pretty much in the same time the Aussie's moved up a little bit higher. So right now, is the correlation what we would expect? Is it this inverse correlation we've seen basically really acting really well up till now? The last few sessions, and I'm going to say basically anything after the 19th, has kind of created a weird little almost sympathetic correlation. Okay, this is likely to be, and we talked a little bit about this in yesterday's chat, this is the week that the market's going to kind of realign itself with what it typically does, because the holiday trading definitely throws it for a loop. So that's a good look at the GLD, the YG, the dollar index, and the Aussie US dollar.